Should you
success?
Good afternoon, fellow investors, and welcome back to InvestTalk. This is our Wednesday, April 24th, 2024 edition. I'm Justin Klein, and I'm excited for this hour with you to help you become a better investor, navigate this crazy market environment. Last night after the close, we had Tesla earnings that were way worse than expected. Stock was up. Meta after hours today, better than expected. Stock is down. These things confuse people, but for a seasoned investor like myself or Luke or Steve, we know how this works. And it's not surprising to us. And so we are here to help give you some context of the market moves, the data that comes in, and help you understand how to implement this into your process, into your strategy, so that you have the right mindset and data, and your eyes are wide open, and you're not confused, and you have clarity to what you are doing within your portfolios. And so that is the goal each and every weekday on InvestTalk. And of course, we're going to run down the market performance for today as usual and the show topics, but we love hitting our first caller question first.
Hi, this is Neil from Chicago. Thanks for taking my call. Really appreciate your show. I had a question about Brunswick Corporation, ticker symbol BC. These are the guys who manufacture and sell boats, all the recreational marine stuff. What are your thoughts about this company? Do you think it's fairly valued? I do own some of them. Should I be adding to my position, or what do you think? Who to the answer on the show?
All right, looking at Brunswick Corporation, and I always think of Brunswick as the the bowling company, but it's no longer that. It is a boat company. It's a leading manufacturer of marine recreation boats, and the firm has more than 60 different brands, and it has what's called a Freedom Boat Club. It's a shared ownership collective, as well as Boateca, which is a facilitates transactions in the used boat market. So it's all about boats. And during the COVID crisis, business was booming. Everyone was trying to get out and enjoy the outdoors, get away from maybe spreading the virus indoors, etc. And their business went from earning $4.33 in 2019, $5.07 in 2020, $8.27 in 2021, and 2022 peaked out at $10.02. But over the last couple of years, earnings have started to mean revert. And this year, earnings are only supposed to be $7.38. So to me, this looks like it's going back to the type of business it had pre-COVID. Now, it's taking a little longer. There's still some remnants of the COVID environment that they're benefiting from. But to me, I don't like this trend. And earnings expectations for this year and next year continue to come down. And it's starting to make a series of lower highs and lower lows. Now, it's a good company. I have no issue with the company. It's just that earnings trend here. They do have some debt, about $2.5 billion on about a $6 billion market cap. That's not egregious. It's not a ton, but it's something to consider. Enterprise value to EBITDA around 7.7. Once again, if EBITDA and earnings continue to trend down, that multiple is going to head up, and I don't really like that. So I would pass on it. Frankly, I just want to see the earnings trends level out and get back to some semblance of growth. If it can do that, and I can see it level off around the $7-8 range, I think that it's cheap. It's a good company to buy. But the technicals are neutral to slightly bearish, and I don't like the earnings trend. So I'm going to pass on Brunswick Corporation. Okay? Now, we have a lot of ground to cover over the next 45 minutes or so, and our main focus point is in regards to something almost everybody thinks about in today's world where mortgage rates are high, interest rates are high, and maybe you are earning a lot in your cash. Maybe you have a mortgage that's stuck down at 3%. You have those golden handcuffs, and you think that's great, but I don't like having debt, so maybe I want to pay that down. These are the questions a lot of people ask. And so should you pay off your mortgage early or invest that money? We get this question all the time. So we're going to drill down onto this story. In addition, we're going to cover a few more topics. One is in regards to the ARC funds. Cathie Wood. She came to prominence during 2020, 2021. And unfortunately, the ARC funds' biggest inflows came in February of 2021, near the peak of the tech boom, the COVID tech boom, shall we say. And according to Morningstar, the ARC funds have now destroyed more wealth than any other asset manager over the previous decade. Think about that. And there are a lot of lessons to be learned here, so we're going to dig into that story. Also, what are the hidden risks in the financial system? And then lastly, if we have time, we're going to go over the current state of the mutual fund industry and look back many years as well and get some context to see where that industry is ultimately headed. We also have some voice bank questions. One is in regards to growth investing, and the other is UPS. I also have some questions that come from our comment section in the InvestTalk YouTube channel. And of course, I welcome your finance and investment questions right now on 888-99-CHART. Now we're going into a short break. On the other side, we'll talk about today's market activity. And please remember that you can call anytime. Leave your question on the InvestTalk voice bank at 888-99-CHART.
You are invited to be a part of our learning experience. Simply use the InvestTalk voice bank to record your finance and investment questions anytime, 24/7 at 888-99-CHART.
Enjoyed our insights on InvestTalk? Great news. Our podcast is available on all major platforms. Make sure to subscribe wherever you listen to your podcasts. Get the latest in investment advice across Spotify, Apple Podcasts, and more. Subscribe now and join our community of informed investors. Now let's take a quick look at the market today. It was a mixed day overall, and the S&P closed slightly higher. The broad U.S. market was up literally 1 basis point. You had the NASDAQ, that was the best performer of the major indices, up 16 points. That's only 0.1%, however. Small caps were down slightly. Mid caps were up a little bit. It was, frankly, a very muted, mixed day. In the midst of earnings season, obviously, Tesla was up 12%, even though they're still down, 30+% since the beginning of the year. You had some, any big losers of note? Teledyne was down 11%. Helen of Troy, 9.5%. Those were kind of the big movers down. And obviously, tomorrow we have the Meta, the reaction from Meta's earnings after hours today that will feed through to tomorrow's earnings or tomorrow's market. We likely have a down day in markets going forward. We're in the midst of a market pullback, really, but so far it's been pretty healthy. Nothing out of the ordinary. You're not seeing the credit markets really blow out or anything like that that's going to give you worry about some sort of broad-based credit event that brings down the value of equities more than 10-12%. It's hard to get a large drop in equities without some requisite comeuppance, shall we say, within the credit markets. And the fact that inflation still remains relatively elevated, right, sticky high in this 3 to 4% range, frankly, I know that sounds terrible, but history says that's actually a very good place for equities or for inflation to be in, for equities to stay in an uptrend. Because it's not so high that the Fed has to get super hawkish, but it's not so low that you get deflationary bust credit events, things like that. They may not seem healthy, but it's healthy from an equity standpoint. And so market was overbought. Seasonally, this is a time where you do tend to get some softness in asset prices before we head into, the late spring, summertime. And that's likely what we are going to get. Now, could we get another move down to say 4,800 on the S&P? Kind of I call this an ABC pattern. We just finished the A first down leg into support right around 49.50 or so on the S&P. Found support, bounced Monday and yesterday. Flat day today. Just a really a pause day as we continue through this earnings season. But could we get that next leg down over the next couple weeks? That's certainly a possibility into that major support level. If you get past 4,800, then maybe you get something more to worry about when it comes to a broader pullback beyond that. Okay. Well, that about does it for the market wrap. And I hope you've been telling your friends about our InvestTalk audio podcast, that it's also available in video form on our YouTube channel. And it seems that every day now we receive finance and investment questions from the comments section of our InvestTalk YouTube channel. And here's one that came in recently. We actually had two questions on this stock. This one came from Jim Leahy. He says, what do you think of CVCO stock for a long-term hold? CVCO is the symbol. Now, this is a name that has been certainly in an uptrend. Let me pull this. It bottomed around $240 per share in November. It peaked around $400 in beginning of April, and now we're at $366. So it is pulling back with the broader market, but what they do is they manufactured homes. They manufacture manufactured homes. So think of mobile homes and not the homes that your typical home builders are building. And in a time when you kind of have a housing affordability crunch, the ability to buy a manufactured home at a much lower price has become appealing. And their business boomed post-COVID. They earned $8.10 in 2020, but $21.34 in 2022. Now, this year, that is supposed to come down to about $18.70, down 31% from last year. But you're talking about a 20 times earnings. That is a bit, that's kind of a market multiple, but the trends in earnings are negative, right? Last quarter, you had negative 11% revenue growth year over year, negative 36% earnings growth year over year. Once again, where does this level out? There's a lot of names that benefited in the COVID era that their business is coming back down to earth. It's mean reverting. And until I get some sort of clarity, some confidence that is going to level out at a much higher level, that we're not just going back to pre-COVID levels, then I'm going to wait. I need to see that, because at $8 a share, like it earned in 2019, 2020, and 2021, $366 per share is not the level it should be trading at. But if it's going to earn around $20 per share, I think this is reasonable. So I don't love it. It just started a downtrend. It is a very good business, I will say that. But I need some clarity on those earnings. And until then, I think the risk is too high, because if you get one more bad earnings announcement that makes it look like it's trending back towards $10 per share in earnings, this is going to take a much, much bigger hit. But a name to keep on the watch list, because it does have some nice profitability, but I would pass for now in CVCO. Now I'm going into a short break. My phone lines are open for your live calls, and they are welcome anytime at 888-99-CHART. Hey, InvestTalk community, Justin and Luke here. We are so thankful you've been with us through this investing journey, but we are just getting started.
That's right, Justin. We're excited to bring you more exclusive content. Think more of the critical analysis and expert advice that you love.
You'll get insights into smart investing strategies to help you navigate these turbulent times.
Don't miss our live Q&A sessions every weekday at 4 p.m. Pacific, where we answer your burning investment questions.
Just call our InvestTalk listener line at 888-99-CHART, leave your question, and we'll tackle them on the next show. Who knows? Your question could be the next big topic we explore together.
So stay tuned and call 888-99-CHART to leave your comments. We're here to make investing accessible, understandable, and hopefully even a little more fun.
Chart your path to financial freedom here with the InvestTalk podcast. Let's go to Mike in Utah looking at Budweiser. Do you own it or looking to buy it, Mike?
I own some, and I'm wondering if this price range is sustainable. Or I know they had some controversy a while back. They dropped for a while, so I'm wondering if this $60.28 is a good buying point to add to it.
Well, it's definitely pulled back from around $66 was its high earlier in the year in January at a low at $57 just last week. Now we're at $60.26, 1.1% dividend yield. Earnings, though, are headed higher. Expected $4 in earnings next year from $3.43 this year and $3.05 last year. So I do like that recovery here. The question would be, what multiple do you want to pay on that? $4 next year, that's about a 15 times multiple. Although, long-term earnings growth here is only going to be mid-single digits. So you shouldn't pay a high multiple. I would say right now, it's about fairly valued. It's a fair price right now. And I like that earnings momentum. So, it depends on your expectations for the brand. Will it continue to recover? It's been in a long-term downtrend. Obviously, it's the world's largest brewer. And the seltzer market has certainly eaten into their business. And I think that's really the big issue because 2019, they earned $4.08. And so $4 next year is just getting back to where they were pre-COVID.
Yeah. Okay.
So that's the struggle here is, will there be a bounce back in market share for beer over seltzers? And what type of growth can you expect? Because it's so large, $121 billion market cap. It's already the world's largest brewer. So it's not like it's going to expand its market share dramatically within the beer category. It's just a matter of consumer taste. So I think it's fine. I don't love it. I don't hate it. I think it's about fairly valued. I just think you could probably use this capital better elsewhere, but it's relatively low risk, good, solid business at a fair price, which, you can't be mad about.
Okay. Perfect. I appreciate it.
No problem. Thanks for the call. Now, our main focus point is about the age-old question of whether or not you should pay off your mortgage early or not. Now, a decade ago, this question was a lot easier. Most people had mortgages around the 3 to 4% range, and the cash in the bank was not earning you much. Effectively zero. Maybe a little bit above zero, but not much. And so when you took that cash and you paid down the mortgage, you were guaranteeing yourself, you were saving that interest. You were avoiding that interest payment. And so that's a easy calculation for most people, that spread. But now interest rates have moved up dramatically. The Fed has raised rates 11 times, and the calculus is a lot different. Now the yields and expected returns on safe investments are usually higher. But there are some questions you have to ask yourself. The first is, do you need liquidity? Do you need to access this money in the future? If you do, I'm going to say future, the near future. 2, 3, 4, 5 years, something like that. If you do, then the answer might be no. Now, you can always get a home equity line of credit to access your equity. But obviously, that's pain. Dipping into your savings account and brokerage account is much easier. And then you have to compare the returns. Now, the core return from paying down debt is very straightforward, whatever your mortgage interest rate is. As of middle of last year, Redfin reported 8 in 10 homeowners had a mortgage rate interest rates under 5%. So right now, 8 in 10 homeowners pretty much can earn more on their cash than they're paying on their mortgage. Now, 1/4 had a rate below 3%, a huge gap. Now, what return you should expect on the investment side, that's a little bit more difficult. Some people say, over the long term, equities are going to do even better than cash, even better than the 7% mortgage that most people are getting on new mortgages today. But that's assuming you have long term. Some people don't. The best and simplest way to look at it, though, is the most conservative investment. Treasuries, cash. And right now you can get 5.25%, 5.5% on treasuries, short term. And that is probably your benchmark. You could use equity returns, but I like to use cash returns. Now, what stage of life are you in? What's your time horizon? What's your risk tolerance level? If you don't have a high risk tolerance level, the return on equities doesn't matter. And if you're close to retirement, that means your time horizon to begin tapping this money in your portfolio has shortened. So that's a big question as well. Those are the first 3 questions, and I'm going to get to the last 4 right after this break. Now, in the next Invest Talk, we'll look into the story, understanding the difference between CPI and PCE indices. That story tomorrow, but for now, I'm Justin Klein. I'm ready to take your calls at 888-99-CHART.
Did you love today's InvestTalk episode? Well, we want to hear from you. So drop your investing questions in the comments below, and your question could be the star of our next segment. Subscribe and stay tuned to see if your question gets answered by us. Dive into the comments now and become a part of our next conversation. Do you want to take your investment strategy to the next level?
We invite you to visit InvestTalk.com and submit your portfolio for a free review from us.
This is a fantastic opportunity to receive personalized advice and insights to enhance your results.
Don't let this chance slip by. Go to InvestTalk.com, submit your portfolio, and let us help you on your journey towards greater investment success. Thank you for watching. Make sure you like, subscribe, and hit the notification bell so you never miss an episode of the InvestTalk podcast. Now, before the break, we were going over the variables that you have to think about when you are trying to decide whether to pay down your mortgage or not. Now, the first is liquidity, right? Do you need this money in the near term? If not, then that's one check box towards maybe paying down that mortgage. If you do, obviously you want to keep that cash more liquid. Number 2 is comparing the returns. What's your mortgage rate versus the returns you can get on investments? And that bleeds into number 3, which is what is your life stage? If you are far away from retirement, then you could potentially use equity returns, expected equity returns, as your proxy for the investment return expectations. If you are closer to retirement, then you need to use something more conservative like the return on cash. Okay. And then what are the tax implications? Now, before the 2018 tax cut, many people itemized and they used their mortgage interest as part of the itemized deductions. However, in 2018, the standard deduction went up so much that 90% of taxpayers now use the standard deduction rather than itemizing. So for 9 out of 10 of you, it's no longer tax deductible. And even if it is tax deductible, you are itemizing, you cannot deduct interest for new mortgages that exceed $750,000. So any amount over $750,000, that part is not tax deductible. Now, if you another consideration is the tax implications of the investment side, right? Taking that money that you have, that cash, and putting into some sort of tax deferred account. Think of like an IRA or a 401k. Also, will making that contribution or that pay down of your mortgage affect your ability to receive your full retirement match or company match in your retirement account, for example? And that could be money that you're giving up. Okay, so not only what are the tax implications of paying down the mortgage, but what about the money you are investing as well? Okay, and then any other carrying costs. One big one is PMI. So if you are paying PMI, you don't have 20% equity in your home, well, avoiding that PMI is a big factor. And that is a big check mark towards paying down the mortgage, getting to that 20% equity, maybe refinancing and getting out of that PMI. Okay. And then a prepayment penalty. Do you have a prepayment penalty on your mortgage? Most do not, but you definitely want to check that out. And then lastly, it's peace of mind. But how secure is your job? How secure is your income? If it's maybe you're in sales and it can go up and down depending on the economy. Or maybe you're in a government job and you are not going to get fired. You feel confident in that. Paying down that mortgage might make more sense than those that are in careers where their incomes ebb and flow. So those are the things to think about. It's definitely not straightforward. There are multiple factors to consider, and hopefully that rundown gave you an understanding of how to tackle that question. Now let's go ahead and drop in to another InvestTalk listener question from 888-99-CHART.
What's up, InvestTalk? I had a question about UPS. Just had earnings today. Also come down quite a bit from its highs back during the COVID times when it was sky high. So now that it's back down, I'm looking to see if you guys think that we're approaching a time where we could enter into UPS for a long-term hold. I'll listen on the show. Thanks, guys. Bye.
All right, looking at UPS, and this is a name. It's the world's largest parcel delivery company. And they have 500 planes, 100,000 vehicles, tons of sorting facilities, and they average about 22 million packages per day delivered to businesses and residences across the globe. And so, you know, it's a wonderful business, frankly. If you look at its profitability, return on equity, about 35%, return of invested capital around 16, 17%. And once again, a great business. Free cash flow about $5 billion on a market cap of $125 billion. Debt of $22 billion. That's not crazy for this level of, a business that is pretty capital intensive. And enterprise value to EBITDA is right around 11. Historically, the average is around 13 times. So, you know, to us, it's a bit undervalued. We recently started to pick up some shares for clients. I will say that 4.4% dividend yield. And, you know, the fact that they had earnings, they weren't great, but they weren't terrible either. And the stock was up on it. So, you know, we like UPS down at these levels. We think it is modestly undervalued, not dramatically undervalued, but modestly undervalued. And for our income-seeking investors, this is a quality name with a quality business. Thanks for the call. Now let's talk a bit about Cathie Wood. Cathie Wood and the ARK funds. And so many people during 2020 and 2021 piled into the social media sensation that was Cathie Wood, that she launched the ARK funds in 2014. But times are changing. The amount of assets in the ARK funds peaked at $59 billion. But just over the past few months, investors have pulled a net $2.2 billion from 6 of their most actively traded ETFs. And that dwarfed the outflows of all of last year. And total assets in those funds have dropped 30% in less than 4 months to $11.1 billion. So from $59 billion to $11 billion. Over 80% drop in the assets in the fund. Now, part of that is money being pulled out, but part of that is also the drop in the value of these funds. If I just look at the ARKK, their flagship fund, ARK Innovation, it peaked out at let's see what the all-time high was, $159.70 today, and that was in February of 2021. So in just a little over 3 years, it has gone from $159 to $43.90. What's that, about a 70% drop? Nearly. And so far this year, with all the AI craze and everything surrounding tech in many ways doing well outside of Tesla, the ARK Innovation Fund is down 16%. The S&P is up 6.3%. And one of the problems here is that these funds are highly concentrated. Many of them have just 7, 8, 9, 10 stocks. 7 stocks make up half of the innovation fund. Tesla is its largest holding, down 40% this year. That was before this recent pop, but still down 30+%. Roku down over 30%. Unity Software down over 44%. These are other top holdings within the innovation fund. And so it's pretty clear that everyone fell in love because they saw eye-popping returns over a short period of time, but frankly, she was just in the right place at the right time. She was talking about these innovative companies that were going to take over the world, and she spun a fantastic story at a time when people were looking, when there were new investors, new amateur investors that did not know what they were doing. That easily fell prey to the promises and the dreams and the stories that she spun. And she got a lot of airtime because what does CNBC do? They don't care whether you make money. They just care whether you watch. And more people watched her exciting stories than, the boring analysis of some industrial company. And so they brought her on again and again and again. And in 2020 alone, the ARK funds brought in $20 billion. People made shirts with their face on it. They called her Mama Cathie. And, it was kind of a cultish following. But as I said at the top of the show, by the end of last year, Morningstar, which analyzes all the mutual funds, ETFs that are out there, they said ARK funds have destroyed more wealth than any other asset manager over the previous decade, losing a collective $14.3 billion. And they also say that, it's kind of at her whim. Sometimes she hits it big. Sometimes she doesn't. Let's look at NVIDIA. She really didn't have a good reason why NVIDIA wasn't in her funds. In fact, she sold it in January of last year, right before it quadrupled. So she's kind of the liability here. And her star power is dimming. And frankly, it should. She should be the opposite of what you look for in somebody to trust, to take their opinion seriously. But you will probably continue to see her because the CNBCs of the world will always only care about whether you watch. They do not care for 1 second whether you make money or not. And this is a perfect example. Now, here's another question from our YouTube channel. Jason Will says, what about TSP Investments and Percentages? I'm 12 years from using the money. Back in 2022, you helped by giving out some advice on air. Wondering if you might feel different now. Well, here's the thing. TSP funds. Let's start over. TSPs are thrift savings plans. This is the retirement plan that most government workers have. And you literally only have 5 funds: the G fund, the F fund, the C fund, the S fund, and the I fund. Now, the G fund is short-term treasuries. The C fund is the S&P. The I fund is EFA, the foreign investments. So EFA is a good proxy ETF. The S fund is the Dow. The Dow Jones Complete Total Stock Market Index. So a little bit broader than just the S&P 500. And then the F fund, which is the Bloomberg Aggregate Bond Index. So here's the issue. I think this is criminal that the government only gives you those options. Now, there are lifestyle funds, but it's just a mixture of those 5 funds. Now, what your allocation should be, frankly, depends a lot on your risk tolerance level, your view on the markets. So I rather have, for example, if I'm going to be in equities, I'd rather be in the S fund than the C fund, because I'd rather have much broader exposure to equities than just the S&P, even though the S&P is fairly broad, but there are broader, right? The I fund, it's EFA, EAFE, Europe, Asia, and Far East Index. It's a widely followed index, but it's not a great one. You know how much Mexico exposure is there? Very little, right? You're going to have a lot of exposure to China, which I don't think you want. So what I would say is you need a professional. We're actually launching workplace retirement advice strategy. So if you want to reach out to us and get more information on that, please do. So I can't really give you the best advice here because I don't know your risk tolerance level. And frankly, as soon as you can get it out of that, maybe roll it into an IRA, I would encourage you to do that ASAP. Now, I think I can squeeze in one more caller question now, so let's play it.
Hey, Steve and Justin. This is Ryan in Seattle. I'm calling about a company RLI Corp, ticker symbol RLI. This is an insurance company I've been looking at via screener, and I'm just curious if you guys have any thoughts on the company itself and whether or not this is likely to remain a low beta stock over a long period of time. All right, I'll listen on the show. Thank you.
All right, looking at RLI Corp, and you got another one. Our listeners are pretty smart. This is a name that we own for clients, and they underwrite property and casualty insurance through its subsidiaries. It's not a big company, $6.8 billion market cap. But if you look at its profitability, it is very strong. Return on invested capital around 21%, return on equity around 23%. The 5-year average on ROE is about 25%. So it's a very, very good business. Minimal debt, actually net cash on its balance sheet. And I like it. I love the trends here. If you look at its cash flow, $458 million, so about a 8% free cash flow yield based on enterprise value. I really like that. And it is trending higher, making a series of higher highs and higher lows. So we like RLI Corp, and it's a very good business. The chart trend looks very good. It's still a bit volatile, right? It moved from 150 down to 136 recently, now back up to close to 150. So I wouldn't say it's low beta or low vol, but it's a very good business in an uptrend, and we like those. Now, this is InvestTalk. I'm Justin Klein. We have one goal here each and every weekday, and that's to help you achieve your own version of financial freedom. And our work continues after this final break. So get your questions in now at 888-99-CHART. Enjoyed our insights on InvestTalk? Great news. Our podcast is available on all major platforms. Make sure to subscribe wherever you listen to your podcasts. Get the latest in investment advice across Spotify, Apple Podcasts, and more. Subscribe now and join our community of informed investors.
Is something on your mind? You can call us 24/7 at 888-99-CHART with all of your finance and investment questions.
Hi, Duncan from New York. Thank you for all that you do. I am now looking at a ETF for India. After listening to your podcast multiple times, it seems like there's going to be some opportunity there. Don't know anything about India or the stocks there, so I'm looking at an ETF, IOPP. It is a Simplify Terra India Opportunities ETF. Heard this over a other podcast for investing. I don't know much about this, but yeah, would like to get a fundamental analysis and just get your 2 cents off of it. Looking forward to hearing from you. I'm also going to put this under my retirement account for a very long term. So thank you very much and have a great day. Bye.
All right, looking at Simplify ETF, Simplify Terra India Opportunity ETF. That is the title. And, it's just been around for a couple of weeks now, really since the beginning of March. March 5th was the first day of trading. I see right here the top 10 holdings. What I would need to understand is, why is this different? The expense ratio is 70 basis points. 70 basis points. Now, there's the India Fund, the IFN, and there's a few others here. That's a closed-end fund. And that one, let me see what the price is for IFN. Oh, that one's a little higher, about 1.4%. So I definitely wouldn't go with that. So it's cheaper than that. I like that. Let me see here. Let me find a better. Oh, yeah, there's the INDA. That is the iShares India ETF. And that's about a 65 basis point expense ratio. So this one isn't far off. So for 5 more basis points, is it giving you something that is more effective, more efficient? I think it's too early to tell. I'd really have to dig into its process. But I like the fact that it's relatively low cost compared to its likely cheapest competitor. iShares funds are usually pretty cheap. So if they're 65 basis points, 70 basis points is reasonable. So I don't hate it. I like India long term. I think there's issues to consider. There's still problems within India and their ability to manage through the complexities of what China did, which is build out a lot of infrastructure to take on manufacturing capacity and build manufacturing capacity. It's something that they've always had the ability to do with the amount of workers that they have, amount of people, amount of human capital that they can deploy. But it's a country that is historically fairly corrupt, and they kind of look down on those that are in, say, the lower income categories. And so it's been difficult for them to capitalize on that. So there's still a lot of challenges with India. I like it as a part of a diversified portfolio long term, and I think this fund is reasonable for that. Now let's talk a bit about the sovereign credit market, sovereign debt markets, and post-financial crisis. The world worked to de-risk the financial system. Pretty similar to what happened in the 1930s, but in a different way. And what you're seeing as of late, though, is the ramifications of that is you can't get rid of all risks that are out there in the market. You just move those risks around. And that's typically what happens. And that's why we say that everyone's looking in the wrong place. Everyone is looking at 08 and they think that the next crisis is going to look like 08. And the reality is that every crisis is different. Why? Because we have memories. We're human. And we go back and we say, okay, what happened in this period that we remember? And how do we avoid that? How do I avoid that feeling again? and they move some things around. And all they do, all the powers that be do, is move the risk from one part of the financial system to another. And now it's pretty clear that the risk is in the bond market and not in mortgage bonds. It's in government bonds. And with inflation continuing to stay relatively high and our fiscal situation pretty much spiraling, it's pretty clear that the quote-unquote risk-free rate is no longer that. That there is a trend towards a financial system that has a lot more debt on the sovereign level, and that the powers that be are going to do what they can to plaster over the imbalances that causes. And that's what happened with Silicon Valley Bank, and that's what you will likely see going forward. So, if you're looking for issues, don't look in the housing market. Now we're heading, that does it. That does it for InvestTalk. We thank you for listening. We encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, or Google Play. And be sure to rate and review on iTunes as well. And check out us on video. And want to see more amazing content, make sure you hit that subscribe button and turn on notifications.
Your support means the world to us and helps us create more videos that you love.
Subscribe now and join our community of savvy investors.